With that, Jeff, can I ask you to come on up?
I spent the first 20 years of my career working with and then running a firm that did insurance defense work. And as a part of that, we got involved with a number of captives over the years. And so it's been a pleasure for me over the years to see that as a growing area of my practice until about a year ago where I branched out, I guess closer to 6 months ago, and I'm now doing that full time. So I'd like to spend just a minute today and talk about what captives are. I know some of you have little exposure to it. Some of you are experts in it, so I apologize that for those of you who are experts, but we want to start real basic so we have everybody on the same level of sophistication. By way of background, captives are an idea that really have begun increasing quite exponentially in the last few years. There are now about 3,000 captives throughout the world. They are in places that you would think of, the Caribbean, Cayman Islands, the BVI, and so forth. But of the 3,000, a little more than a third are now in the United States. And this has been a kind of a move that's been very interesting to watch as the United States decided, and I mean the states, decided that they were tired of getting kind of inappropriately competed with by offshore business. So now many states have really put a very concerted effort into becoming captive jurisdictions, and in some senses the United States is now becoming a tax haven for other countries. Just to give you some idea of the magnitude of this, I think Vermont has a little over 500 captives. That's the largest jurisdiction, or the jurisdiction with the most number in the United States. It's about a $2 million a year industry in Vermont. It doesn't take any great scientist to figure out that if you've got $2 million coming into your state and you don't happen to live in Vermont, you'd like to have some of that in your state. And so a number of states have passed captive legislation to try to entice some of this business into their jurisdictions. South Carolina's pretty big. They have about 120 or 130. Hawaii has about 150. And then there's a variety of other states that have adopted captive legislation that are aggressively vying for this business. We would like to start with a couple of basic definitions, just so that everybody, again, is on the same page as we talk about some of these concepts. Essentially, when we talk about captives, what we're really talking about is a unity of interest between the insured, the person buying the insurance policy, and the insurer, the company issuing the policy. That unity can be very close or it can be quite remote. And so we want to just kind of put that into some concepts. An operating company as owning a subsidiary, which is the insurance company. This is the classic kind of captive. Some people refer to this, and it's often, you'll see it in print, as pure captive. This is the classic definition of a pure captive. There's an absolute identity of ownership. There's also an absolute identity of interest. If it's good for the operating company, it's good for the insurance company, and vice versa, because they're essentially the same. There's some very large examples of this. General Motors, for example, has a pure captive. It's in Bermuda. It's General International. Fluor Corporation has 2 captives, one in Hawaii and one in Bermuda. Sears owns Allstate, or at least they did at one point in time. These are all pure captives where your organizational structure is just pretty straightforward. The transaction between these two companies is very simple. You pay premium, you get a deduction for that, hopefully, if you do it right, and the insurance company issues insurance policies to the mother company. The next idea, or the next concept that we want to define, is a brother-sister captive. This becomes very important from tax standpoints, and Brian is going to deal on that later. What I'd like you to know from my standpoint, from the legal standpoint, is that this is a very flexible concept. So while the parent company owns both the insurance company and the operating company, the operating company buys insurance and pays premiums to its brother-sister company, and that, for tax purposes, has enough difference of ownership that the IRS treats that differently in many instances than a simple pure captive or a simple subsidiary parent-child relationship. This is a very flexible concept. Brian and I have a client that has a structure very similar to this, where there's some trusts that own LLCs. Each of those trusts own both the insurance company and some operating companies, and the operating companies purchase insurance from the insurance company owned by the trust. From an insurance standpoint, this is a brother-sister relationship. And also, most folks would say, or most insurance people would say, that this is also a pure captive, because the unity of interest between the insurance company and the operating company is identical. They're all owned essentially by the same group or the same company. So this is a very easy thing for us to deal with. The regulators, insurance regulators, like these structures of pure captive because they don't have any problems dealing with them. In other words, it's your money, it's your risk. If you make some business decisions that are bad, you're going to suffer for those business decisions. No one else is. So these companies typically have fairly limited regulation or fairly limited scrutiny from the regulators. From this, we want to look at what becomes more complex, and this is a group captive. Group captives define a wide range of business organizations, but the essence of them is that they have a group of unrelated parties that come together for the purpose of forming an insurance company, and essentially they insure each other. There is a low unity of interest here. What may be good for one insured, it may not be good for the insurance company or for other insureds. This kind of organization has the real stresses that a real insurance company has. Bad faith law, for example, applies to this. An insurance company is obligated to use its best and highest good faith for the benefit of its insureds, and if not, the insured is given a right of action in every state, although not necessarily in every country. And so this kind of an issue, or this kind of a company rather, can have that issue, can have bad faith type issues. Reasons people form group captives is primarily economies of scale. Forming an insurance company is not an inexpensive venture, and if you can have a number of folks come together and defray those expenses and put enough premium in to make it operate like a real insurance company, that's obviously a benefit. The trade-off on that is that you do give up, obviously, some control. An association captive is a kind of group captive. This is where an association creates or facilitates the creation of the insurance company. If you think about kinds of structures like this has been very common in many professional settings. There's an oral surgery association captive. There's an orthodontic or association captive. If you buy insurance from AAA, Automobile Club, that is essentially an association captive. It's a little bit different structure than this, but it's the idea is that a number of people, members of the association, come together, and the association can provide money, it can provide administrative support, it can provide all kinds of things that are of benefit to the members, and that's the basic concept. This is typically, an association captive is typically not a profit-making operation. It is created just to provide benefits back to the members. And it does that in a variety of ways. I'll tell you, this is the association captives, and particularly a particular type of association captives, have been very popular with 501c3 type companies. I've had a number of inquiries from museums and other kinds of nonprofit organizations that just don't think they can find commercial insurance that is going to suit their needs, and they come together to basically insure each other. There is another type of group captive, and that is a so-called Renta Captive. And so let's define what that is just for a minute, because this has had some play in recent years. A Renta Captive means that the insured, you, actually don't own the captive. You're just buying a piece of its capital for your purposes.